everybody. Welcome to the latest edition of the NTC podcast here. Just want to welcome everybody back to the show. Hope you guys are all going to have a happy Memorial Day weekend. This podcast is for May 24th, 2019. In the first introduction episode, I was speaking about some things for everybody to go over about hurricanes, Ohm's law, and the laws of energy. These are precisely how our monetary system works. I know it sounds crazy, but we're going to get into one of them tonight. We're gonna focus on the hurricane model here. But what everybody needs to understand first is that our currency is debt based. So if you take a dollar bill out of your pocket and look at it, it says Federal Reserve note on it. This note is good for all debts, public and private. In the financial world, a note is a debt instrument. So all the money in your pocket, all the money in your bank account, everything is debt, and it's owed back to somebody plus interest. All right, but the only problem is that the interest does not exist yet. So we have a very unstable system. So that's basically where money comes from. It comes from a bond. Once a bond is issued, it's then monetized and it gets loaned down. Think of a pyramid. Interest rates are cheaper at the top of a pyramid, and as you go down the pyramid, interest rates get more expensive until they get all the way down to you and me. So you have to think of it that way. And then on the bottom side of this pyramid, split the pyramid in two. One public, one private. So basically government and us. And then all that money is then cycled back up to the top, plus interest. So every dollar in your pocket is owed back. It's not yours. You worked for it, but it doesn't belong to you. It's not yours. So that's what we need to understand first. Further review on that subject, I highly recommend a YouTube video called Renaissance 2.0. It is a very, very good video. So I highly suggest you watch that if you really want to understand how that works. But tonight I want to get into the hurricane model here because there's been a lot of talk on CNBC and the news lately, the inverted yield curve, and a lot of people don't understand what that means. So I'm going to try to break it down as simple as I can. And a hurricane is the best model when you're dealing with interest rates and yield curves, because I think everybody out there understands how a hurricane works. Is that it's a breakdown in the Earth's atmosphere, and you have the eye wall where the pressure is the lowest, and what it does is it's just a big giant vacuum, and it's just the outer bands are just sucking all the energy from the warm water in the atmosphere, compressing it and pulling it to the center. Well, that's exactly how a yield curve works. So think of the eye of a hurricane. Think of that as present day, and then move out the bands until you get all the way to the end, and we'll call that the 30-year bond out there. So the way it's supposed to work, as you move further off the yield curve, the rates are higher, right? Because you're tying up your money for a longer period of time, so you want a greater return on your money. That would just be common sense. All right. Well, that's exactly the way a hurricane works, is that it's constantly sucking from the outer bands to the center into a low pressure. So as the hurricane grows, the pressure has to constantly lower and lower and lower and lower. So the lower the pressure, the bigger the hurricane gets. And it also, on a yield curve, you could also plot that axis out as time. And so you're basically sucking money from the future, bringing it into the here and now. And along with that, you're bringing in resources and everything else that are not even paid for yet. You're bringing them all right into the here and now. So that's the way it works. So what we have in this current day, in a current normal model, let's just say you have the 3-month bond right here at the eye of the hurricane. That would pay a less rate than all the way out here at the outer bands a 30-year bond would pay. So as of today, right now, they are the The 3-year, the 2-year, the 5-year, and the 10-year they're all inverted now. The only one that has not is the 30-year. But that's what this means is, all right. As of right now, the 3-month bond is paying 2.34%, and you come out a little bit here. Let's call this the 2-year. That's paying 2.16. That's lower. You're getting paid more money to tie your money up for 3 months than 2 years. And then let's come out here a little bit to the 5-year, and that's paying 2.12%, even less. All right, but then the 10-year is paying a little bit more than the 5-year, but the 3-month way back here is paying more than the 10-year, and then the 30-year is at 2.7%. So basically, what that means is that when a hurricane's out over the ocean, the fuel for a hurricane is warm, moist water. So, I mean, I don't know how big a hurricane could possibly get to if there was no landmass for it to slam into and break up. But that's all it does is it just sucks up moisture and fuels it. Well, that's the same way this monetary system works. Think of the size of the hurricane and all the bands as interest rates, and the fuel being people. All right, and the people's ability to go into debt. So the more people that are out borrowing money and taking out loans and springing new currency into existence, the bigger this hurricane gets. It's that simple. So a hurricane sitting out over the open ocean with people just borrowing a bunch of money, that's inflationary. That's very inflationary. It only becomes deflationary when the hurricane slams into shore. And that is what the yield curve is telling us is happening right now. Because the outer bands are starting to collapse on it. Okay, if that makes any sense. Meaning that the interest rates should be growing as you get further out to the outer bands, but they're actually in the middle, they're starting to break up. So that's less energy that's being sucked into this thing. So by my monetary thesis is that I'm a deflationist. I'm not buying the inflation theory. I'm not buying the hyperinflation theory. Not right now. Not in this environment. It's not happening. Because you need to have, in order for us to get into hyperinflation right now from where we're at, the yield curve these rates would have to be just a lot lower, and they would have to work in succession, meaning you couldn't have an inversion. The inversion yield curve right now is telling you that this hurricane is getting ready to slam into the shore and break apart and go through deflation. All right, and that's how the Federal Reserve can manipulate this hurricane, so to speak. All right. By controlling interest rates, they can bring down the central pressure. So think of interest rates as pressure. All right, and a hurricane grows as the central pressure in the eye wall lowers. All right, same thing in the monetary system. When they lower the interest rates by the Fed funds rate, and by them quantitative easing, just getting out into there and buying bonds, they're actually lowering the central pressure of this hurricane and allowing it to grow. All right. But there's one problem, is that they can lower interest rates as much as they want. If the public is not willing or unable to take on any more debt, this thing slams ashore, and that's what's happening. We've reached peak debt. There's no more juice to squeeze out of this grapefruit. So that's essentially is what's happening, and that's what the yield curve is telling us right now, is that the hurricane is starting to break apart. Instead of having a nice even rate curve or a yield curve and a pressure curve, you're starting to get the imbalances, and that's telling you that we're going to go into a deflationary recession. That's what this is going to be, and that's pretty much how it works. I mean, and another thing, in order to have hyperinflation, I got a chart up here of the velocity of money. That's where we are right now. We're at all-time lows. It just means money's not moving around the economy. People are not borrowing money. People are not going into debt. How in the heck could we get hyperinflation when you have money velocity this low? All right, this was prior to the dot-com bust, and this was prior to the 2008 bust here. All right, you had inflation during the 2008 bust. All right, but what did the Federal Reserve do to counteract that? They rose the central pressure of the hurricane, meaning they brought interest rates up because they knew we were going to get into runaway inflation. But by them tinkering with interest rates, that's what it caused. The big collapse in the velocity of money. And 2008 just caused that hurricane to slam onto the shore and break up. So that's where we're at now. That's why I have a deflationary theory over a hyperinflationary theory. And I think Mike Maloney says it best when you have a general population that has done nothing but take on debt, corporations and governments as well. Why on earth, if you could look through a time in history, why would general population and everybody else be rewarded for mass stupidity? Right? Find me a time in history when the general public has been rewarded for mass stupidity. He's got a brilliant point there. I can't agree with it anymore. So that's pretty much where we're at right now. And I mean, there's no better evidence to show that than right here on this chart. This is a chart of the Dow Jones. I'm actually going to focus in right here. This was This was our 2018 bear market pullback, whatever you want to call it. But it was a nice quick V-shaped recovery. But at the time, what was happening right here? In this time right here, this is when the Federal Reserve was saying, we're going to be aggressive raising rates. So supposedly, according to them, they stopped buying bonds. So, you know, I still think they had a backdoor bond buying program, if you want my honest opinion. But they were, for all the quantitative easing that they did from 2009, they were going to start selling those bonds back into the market. So what were they doing? Raising the pressure of that hurricane. And you could see it perfectly right here. You could see it perfectly. It was literally on this day right here. This day right here, Jerome Powell comes out and says, "We're not gonna raise interest rates anymore. We're all done." And what did they do? Lowered the pressure of the hurricane. What happened? Allowed it to jump back up. So, I mean, that's pretty much where we're at now. And the only way, like the way our system is set up, the only way, and this is going to sound absolutely crazy, but these people are not crazy. That's what you need to understand. You watch the news, you hear some of the things these people say, it sounds off the wall, but if you understand the monetary system, it's not crazy. You understand it 100%. You got this idiot, yeah, I call her an idiot, but AOC out there, Bernie Sanders, these guys of socialism, they want to give everything away. They want to give free money to everybody. All these cockamamie programs out there. But to the person who doesn't know any better, that sounds absolutely crazy. Well, remember, money has to be borrowed into existence. If the general public is unable and unwilling to go borrow money in order to keep this system going, they got to start giving money away. I know it sounds stupid, but that's the way it works. That's the way that it works. They have to give the money away in order to bring the velocity of money up and to keep the central pressure in this hurricane lowered to allow it to keep going. That's as simple as that. And that's how we got to this point here. That's how we got to this point. After the 2008 meltdown right here, the Federal Reserve, after they just started a new hurricane. And this is a full-blown Cat 5 right now that we're at. So, I mean, that's pretty much how it works, as far as that goes. I mean, I hope it's been, informative and you could understand that's how this system works. It models a hurricane perfectly. It pulls money from the future into the center for the here and now. And that's exactly what a hurricane does. It pulls energy from the outer bands right into the eye, strengthens the eye wall, the here and now. But like I said, with the yield curve inverting, that's what that means. It means that the outer bands are starting to break up, and that it means it's coming aground. And the only way they can get that to reverse itself is they have to have the general public get out there and take out more loans. I mean, they can bring interest rates all the way down to zero if If I got $40,000 in credit card debt, what good is a credit card with zero interest going to do me? I can't afford the payment anyways. It doesn't matter. So if they can't get them out there to borrow money, they have to give it away. And this is a lot of people talk about our welfare and our social programs. It's the way it is. And it's just the way the system's designed. To a lot of people who don't know any better and don't understand it, it sounds crazy. But once you understand this system, it's not. It's not crazy, not at all. And so I mean that's where we're here at now. And I mean this is about the last year and a half of the Dow. And look at that. We got a nice little triple top going there. So I think there's some downside to come, but if they can't fix this and these rates start rising, this is coming down in a heartbeat. This is going to be coming down real fast. So that's all I got for tonight. That was just a little lesson on the hurricane, and the next two I'm going to do probably on energy, and we'll do some Ohm's law. And I just want to get these out of the way because the things that we start talking about, when we're reading stories or looking over charts or whatever, you'll have an understanding. And that's what we're trying to do, is to get you a basic understanding of how this works, so that when this does crash, you can capitalize on it. Because that's what I'm going to do, and that's what all the people I work with, that's what we're going to do. But that's what we're looking for. This problem is going to start in the bond market. It's not going to start in the stock market. The stock market's just going to be a reaction from what happens in the bond market. But that, like I said, that's the whole point of this. But if everybody starts getting in on these trades, I want you to know why you're getting in on them. And I think this is important to understand these things. First have a good grasp of how this system works. Yeah, I got a lot of a lot of people that that write to me that are they're gold bugs. I'm a gold bug myself. Don't get me wrong. I understand the importance of sovereign money, but we don't live in that system. We don't. You have to see things for what they are, not for what you want them to be. All right. I have been buying precious metals. I continue to buy them. I've slowed the pace down a little bit, and the only thing I have them for is insurance. That's it. Because I think in this, well, not that I think. I mean, if we go into a deflationary spiral, a death spiral, I call it, the dollar is going to gain so much value. Well, if the dollar gains value, that means gold and silver are going to lose value. It's just that simple. The only reason that I am holding the amount of gold and silver that I am right now is that I do believe that the prices that they're at now are pretty close to mining cost. It doesn't mean they can't go under it, but I just think that the downside risk is pretty mitigated at this point, where I don't think they can go down too much more. Time will tell. We'll see. I don't know. But in a deflationary environment, unfortunately that's what happens. And I just see a lot of these people that are loading up on precious metals that when the initial collapse, it's going to take everything with it. Everything's going to go with it. I don't care what asset you're holding. It's going down. It's going down to the dirt. Now, on the flip side of that, the government's reaction to this crisis, that's going to paint a whole different picture. That's when you may want your metals around, because that's when they may just start mailing checks to everybody for all the taxes you ever paid during the course of your lifetime. Everybody opens their mailbox and they get a check for 30 grand. It's possible. I mean, this system is so screwed up. That is not out of the realm of possibilities. So, but that's where I think we're going first. Is we are going into deflation. We can't go into hyperinflation right now. The elements are just not there for it. They're just not there for hyperinflation right now. So that's what I got. I'm gonna let you guys go here. Enjoy your weekend, and I will have a new video out in a couple days. And like I said, we're gonna go out and cover up a couple of other things, and then we're gonna start taking that knowledge and we're gonna start applying it to these charts, and we're gonna show you how to kill it and kill this market, and hopefully build some generational wealth on the way down. Because I can guarantee you, That's what every hedge fund manager and all these big wigs and the one percenters are going to do. Okay, because the general population is just going to be slaughtered. So you just got to position yourself on the right side. So that's all I got. Have yourselves a great weekend. We'll talk to you on the next episode.